Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dynison.
Welcome to Accounting in the Wild. Before we get started, we'd like to tell you that this podcast is sponsored by MyCPE One. To watch the full episode and earn CPE credits, head over to my-cpe.com and continue your professional learning journey. And now, to the show. Well, welcome to another episode of Accounting in the Wild. I'm pleased to have Herb Cogliano with us from Aspire Growth Advisors. So, Herb, let's start with kind of the stereotype here of who are you? What would be your elevator pitch, I guess, if you had to introduce yourself to a room of people?
Yeah. First of all, Jason, thank you for having me to be part of this wonderful podcast community. I've been very fortunate that I've been a CEO for over 35 years, multiple companies, different industries. But in the last 6 years, I became a scaling up business coach. So what I do is use a certain growth methodology based on the book Scaling Up by Vern Harnish. The book is a playbook for the different elements of growing a company successfully. Less than 0.5% of companies in America, there's over 30 million of them, ever make it to 10 million a year or more in revenue. So scaling up is not impossible, but without the right playbook can be extremely difficult. My personal journey in a family business, second generation, we got stuck. We hit a ceiling of complexity. Our sales were starting to flatten. We cannot get year over year growth. And that was problematic. And so we needed a different way to approach it. And scaling up has been a playbook that's helped me do that for the last 25 years. And so excited to share some of that insight with your listeners.
Yeah, well, Herb is someone who I've got marked to come back several times. Hopefully we don't scare you away today, Herb. I don't think we will. You and I have spoken offline several times. I think we've got some great things that we could talk about. But today, exit planning and maybe touching also on starting to scale. I think starting to scale might be its own separate interview some other time, but it kind of ties into this. But exit planning is the topic of this podcast. And I know you're working on becoming a certified exit planner. But before we talk about that, let's define what we mean when we say exit planning.
Yeah, so exit planning is dealing with the whole situation of a business owner, their personal needs, their financial needs after their exit, and then the actual needs and valuation of their company. And taking that holistic approach involving all the right parties, from your partners to your spouse to family members and all of your trusted advisors, your wonderful CPA, your attorney, your wealth advisor, and people like me as a growth advisor, quarterbacking your journey to make sure that something you spent your career in life building gets you the ultimate value and outcome that you want. And I love this saying because somebody told it to me during my CEO journey. Every company will have an exit. The question is, do you want to be the author of your final chapter, or do you want life circumstance to do it? And that was all they had to say to me. I want to be in the front of it. I want to understand it, and I want to guide it to a great outcome for me and my family and my team.
So many businesses. I mean, before we started rolling here, we're talking about the tiny little fraction of businesses that reach 10 million. Is it 10 million in revenue?
Yes.
And what was that statistic again?
Yeah, 1/2 of 1% of over 30 million companies in the US ever make 10 million or more in sales per year.
So I know that on the exit, where I'm going with that and why I asked about it was because so many of us, I'm guilty of this. We might say we're entrepreneurs, but we're kind of worker bees. A lot of us business owners are. We own a job, and we're in charge, but we get up and we go to the salt mine every day. And there's a certain, I mean, you touched on this with your family business. You reach a certain plateau. I reached that plateau and am still trying to push past it. It's like you reach a certain point where it's like, okay, I can't do any more than I'm already doing. There's a lot of people who try to do more and they keep running themselves into the ground, but that makes it hard to actually exit without throwing your hands up in the air and just walking away. Or I know in the accounting business, no joke, there are accountants who literally keel over at their desk working on tax returns. I know that has seriously happened multiple times.
Yes. Yes.
And I guess where I'm going with that is scaling, growing your business and turning it into something saleable, I guess, it's a good goal because otherwise, how are you ever going to get out of this, right?
Yeah. Some of the research that I've been seeing, Jason, is that almost 80% of an owner's total net worth is made up of the worth of their company. And if not handled correctly, that could be a very challenging outcome for somebody if that value is not optimized. You look at the business owner and you start to ask them questions. So here is the big thing for me. I don't know if you've felt this way, Jason, but most people think of exit planning, oh, we only do that when we're ready to sell. You wait 2 to 3 years, you bring some consultant in, they'll get it pretty, put lipstick on it, and you're ready to go sell. That's not what I've learned is best practice. What I've learned is exit planning is a business strategy that has to be brought into the present tense of what do I need to do now? And there was some very important things that people started to ask me. Number one, Herb, what is your wealth gap? If your business was gone tomorrow and you wanted to do charity work, how much annual income do you need in order for you to have that life? And nobody's ever asked me that before. And the gentleman said, here's some simple math. Take whatever you need to do. And this particular business owner needed $400,000 a year for their lifestyle. Divide that by 4%. That's a $10 million a year net worth, not including your business. So if you look at your 401k, your IRAs, and all that stuff, and let's say that number is only 2 million, you have a wealth gap of $8 million that you hope, if and when you exit, your business can give you. And a lot of owners don't realize what their current profit gap, which is the amount your company is worth today versus the amount if your company was highly marketable at a best-in-class status. So we saw another company that didn't have a good leadership team in place, highly relied on the owner for the major things that needed to be done, sales and operation. Had several large clients that were a high concentration of their overall sales. And in the industry, the multiples went from 3 to 8 times, 3 for the lowest, 8 for the best in class. And when we looked at his numbers and did the readiness survey, they were a 4 multiple, and they had lower operating profit, around 10% operating profit, when the industry top performers were over 20. So number one, his profit gap was lower because he had the potential to be a best-in-class 20% operating profit company, leaving a lot of money on the table. Then his value gap was lower because he didn't have a high profit gap and he couldn't get the highest multiple in the market because he was so dependent on him and a few clients. So in that particular example, there was like a $15 million gap in what his company was worth and what it could be worth if he focused on the right things. And so when we have your wealth gap narrowed, your profit gap narrowed, and your value gap maximized, you're going to make the best decision whenever you want to exit. And that's what the journey's all about.
And really, you talked about this, that exit planning is not something that you should be doing when you're 65 years old or whatever. It's something that would you say everyone pretty much should be thinking about this if you own a business? Because I guess I look at it as it's kind of morbid to think about, but there's going to be an end to this story at some point. And it's like with your business, there'll be an end. And what's that?
Yeah.
I mean, you mentioned writing the final chapter. What does that look like? Do you get to ride off into the sunset dramatically, like in an old movie, or are you going to be one of those, like an accountant who has a heart attack working on a tax return at midnight, on April 14th?
There are 5 Ds that impact your business. Number 1, exit planning, death. God forbid you or a partner is not here. Mm-hmm. Disability, you become disabled and you can no longer work the way you did. Unfortunately, divorce, distress, and disagreement, a partner disagreement, any of these 5 Ds have messed up many a business owner that was not seen or planned for when they had to actually exit their company. And that's scary.
Yeah.
Because we always think of the things we control. Oh, there'll be plenty of time to deal with that. And yet these things hit you. And that's why we want exit planning to be an ongoing business strategy so that whenever you decide, and Jason, here's the idea I want you to think about as an owner. Every 90 days, when you plan for the next quarter, you should be asking yourself, am I still excited about the company? Do I still want to pursue growth, or do I want to exit? And answering that question then triggers, with the planning that I've done, if I want to grow, then I'm going to start doing added value type strategic priorities, and you continue to grow. If you decide for whatever reason you want to sell, we then start looking at exit options. Do we want a generational transfer to my son? Do I want a partner buyout? Do I want a managed buyout? Do I want an ESOP? Or do I want an external buyout by a strategic buyer, financial buyer, maybe a recapitalization where I'm taking money off the table? or the least unfortunate or the most unfortunate one, do I have to do an orderly liquidation and shutdown? All of these are range of options that every 90 days we ask our owners, what are we doing? Continuing, or are we taking the next step? But it makes them feel empowered that they now have this ongoing look and they have a choice. And their company, one of the biggest attributes of value in a company is transferability, so that you are working on the company and not in it. And that transferability deals with four major areas. When you look at the balance sheet of your client, Jason, you're looking at tangible assets, aren't you? Cash, inventory. When a buyer looks at your company, he looks at the physical, tangible assets, but so much more. Human capital, the tenure, the retention of your leadership team. You're looking at social capital, your brand identity in the market. They're looking at structural capital. Are all your processes documented and systemized? And then they're looking at customer capital. What is your client retention, your client concentration, your client growth and acquisition strategy? Those intangible capital is more valuable to the best multiples than the tangible assets on your balance sheet. And most owners don't know that.
What I love about talking to you, Herb, is that it's like you have systems for pretty much everything, and the four steps and the 5 Ds and all those things. And it's like there's a lot of people in this field who, and when I say people in this field, I mean people who talk about things like growing your business, scaling it. In the accounting world, advisory is a big buzzword, and it just gets thrown out like do it. But it's there's not a roadmap or anything. I feel in talking to you and looking at your website, some of the Rockefeller systems and stuff, it just fascinates me. You have, I guess it's fitting that you've done this for 35 years now. I mean, there is a path, right? This isn't necessarily, some people might get intimidated by exit planning. What do I even do? There are roadmaps though, right?
Yes. And it's very important that you have them, whether you create them on your own or whether you work with an advisor. I think the simple wisdom is you don't have to figure things out on your own. If you work with people who have been there, done that, they make your journey so much smoother. And I am a benefactor of working with some amazing people over my 35 years. And now it's my gift to share that with others the way people so humbly shared it with me.
All right. So you had mentioned wealth gap, profit gap, and value gap. We touched on the wealth gap and the difference between like whatever the industry standards are for, how much your business would sell for. And you touched on profit and value, but I guess we should talk a little more about those. What do we mean when we say profit gap?
Yeah. So when you look at a financial statement in a company, especially a privately held company, we want to look at your recasted EBITDA. Now, Jason, you're an accountant, CPA. Most business owners don't know what the hell I just said.
Right.
So a recasted EBITDA is your earnings before interest, depreciation, tax, and amortization. The recasted part is that privately held companies have add backs and take backs. So if I paid myself $400,000 a year as the owner, but when I leave the company to replace me as a manager for the new owner, market rate may only be $200,000 salary, not $400,000. So I get to add back 200,000 to that EBITDA. If I own the building of my business and I'm the landlord and I charge my business 12,000 a month in rent, but I look at the market rate and the market rate is only 6,000 a month in rent, I get to add back the 6,000 a month to my earnings. If a take back is your debt, so if my business had a certain amount of debt, or maybe you can help me, Jason, maybe you have an example, but whatever I'm going to get from the business, if I have debt, I have to pay that back first. I don't just get all that money as a freebie.
Right.
But you come up with a final number, which is maybe different than what you see right now when you look at your P&L. So most owners do not know what their current recasted EBITDA is. And you want to find that out.
Yes, I would agree with you. I would say that there are even some accountants out there who don't really know what EBITDA is, just because it's not something that comes up with Main Street businesses. But even a Main Street business does in fact have EBITDA because they have depreciation and interest that they're paying on loans and such. So I mean, every business actually has that.
Yes. So we'd figure out what that was. And let's say you did 10 million in sales and you did 10% profit. That'd be $1 million, let's say EBITDA with all the add back. Now I want to go to the value gap. Value gap deals with a range of multiples. Have you ever heard your friends in the industry say, Joe sold his company, he got a multiple of 7x, 7 times EBITDA?
Mm-hmm.
We as the owners do not determine the range. The private capital markets determine that range, whether it's 2 to 4, 6 to 8, whatever. But you need to know where you fit in that range. And so you want to do a readiness assessment that, do I have the right human capital? Do I have the right customer capital? No big client concentration. I'm not the guy managing sales. I have a sales team. I have an operations team. All these things that make you very replaceable. Is everything documented? All my systems? And what is my brand identity, my social capital, best place to work, all these great things. And then you're going to look at that range of multiple. And if it's a multiple, let's say between 3 and 8, and I'm highly involved in the company and I have high customer concentration and I don't have a very established leadership team and I don't have things well documented, the odds are I'm going to be closer to a 3 in the range of multiple versus an 8. Now, imagine on that 10 million, I have $1 million EBITDA, but the best in class in my industry is a 20% EBITDA, which is 2 million. So I'm $1 million, they're 2 million. I now do my million times the low range, which is 3, a multiple of 3. I have a $3 million value for my company. I take the best in class company, which has a $2 million EBITDA, multiply it times the high end of the range, which is an 8. And now I have a 32, right? 2 times 8, 16.
16.
So now I have a $16 million value versus my 3, and I'm leaving $13 million on the table.
So that old cliche about, investing or, you spend money on certain things, human capital, hiring the right people and such. That really is an investment in your business. When you get all those things straightened out and you spend a little money here, it'll come back to you in multiples down the road.
Yes. Yes.
Yeah.
And it will give you more safety and security. And remember, value is locked into transferability. If I'm the buyer and I'm looking at your company and I see how you are not needed in that day-to-day part of the business and it's running and operating with great people, great brand, great systems, it makes the value locked in for you, even if you want to still do work in the company, which is great. But now you have a choice and you don't leave that value gap to your disadvantage. So that's what we want owners to think about. Most owners don't know their wealth gap, their profit gap, and the value gap.
How would you, and to just get started, as so many of us as business owners, not just accountants, but across all industries, we work in our business. We work in it instead of on it, as you said, and as the saying goes. What do you think a good first step is for those of us who get locked into, oh, I've got to do the work? I mean, we could say, oh, well, you need to delegate, but how do you really make that first step where you start changing the brain waves and the connections on all this stuff to where it's like, yeah, I'm actually going to do this? Like, what would be a good way to get started on that task?
Yeah, Jason, I think the first question you want to ask yourself is, why do you even want to do it? Like, what's your end game? We had one gentleman that him and his family had lived in this neighborhood for many years because he, quite frankly, always put all of his money back in the company. So he didn't have a really incredible home and he didn't live in an incredible neighborhood. But as his kids were getting older, it was becoming very apparent to him and his wife that they wanted to move into a bigger home, a different area, and one of their children had some disability that required some special ed and help, and he didn't have enough personal net worth to take care of it. So when you talk to a person like that and say, why would you want to go through this process? His why was so strong, he was willing to walk through fire to figure out the wealth gap, the profit gap, and the value gap. So that's kind of, I mean, it's hard work. If it was easy work, everybody would be doing it, but it's not work that cannot be accomplished over time if it's part of a current ongoing strategy versus a Hail Mary in the 11th hour, which is how a lot of people see it.
Exactly. So when we say, exit planning and scaling up, what are some goals for people to shoot for as far as like maybe a revenue amount? If there's someone who's kind of at the start of the journey and they're just toiling away as them and their business, or maybe they have a few employees helping them out, but it's a lot of it revolves around them as the business owner, and they're making maybe a few $100,000 of net profit. Where do they really need to be in to really be in the game on what we've talked about?
I think first things first, there's two journeys. I don't know why, but they seem to pop up over and over for me. Number one is if you're below 10 million, how do I get to 10 million? And then once they get to 10 million and they see their people systems working, they see their go-to-market strategy working, client working, growing, they want to get to 100 million. And kind of you either have this, let me get to 10 million, life is so good, I don't need anything more, or life is good, but I know it can be so much better. I want to grow, 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 grow. And those are kind of the two big areas that I see people, but there's a reason why the majority of the people that don't make it to 10 million is 99.5%, because there's a lot of lifestyle companies that people love their own schedule, their freedom to do what they want when they want, maybe not manage employees, maybe not get a lot of risk or overextended in growing a business. They just like their sweet spot. And there is nothing wrong with that at all.
Yeah. Yeah.
But there is a portion that want more. And for that portion, what I love about scaling up with exit planning, if you go through the wealth gap and then the profit and the value gap, and they're large gaps, you want a scaling up coach or advisor to show you the playbook on how to increase your profit and your valuation. And so the tools back into, you now know what the gap is, what are you going to do about it? And we have the playbook to help you realize it. And that's the action plan.
All right. Well, Herb Cogliano, is there anything else? Well, there is one more thing, at least one more thing, and that is you're working on becoming certified in exit planning. I've heard a lot about exit planning, but I haven't actually heard about the certification. What is that?
Yeah, so the Exit Planning Institute is an organization that educates and credentials advisors so that they are trained properly to work with the business owners and other advisor partners, a CPA, an attorney, a wealth manager, in a coordinated way so that they can give the best education and guidance to the owner. And because it is a certification, there is an examination, there's an educational component, there's an ongoing continuing ed component to make sure that the industry and the advisors have great upstanding and support the owner and have a integrity and an ethics built in that we're going to do that wisely and appropriately. So I love the rigor behind the system, and I love to know that our work is being watched and that we're getting the best training before you let anybody start working on your company.
Well, excellent. Herb, is there anything else that we need to talk about? I'm sure that we could talk all day about exit planning. Is there anything off the top of your head, though, that you think is like really vital that people need to know that you want to add, or any final thoughts you want to share with us?
No, I think every owner deserves the company of their dreams. They just may be struggling with how to create it. And there are systems and people that can help. And I just wish and encourage you to find those systems and people that will help make your business dream a reality. It's been such a gift for me to be working and running and building companies with amazing people over the last 35 years. And I want to see that wish come to reality for others. So that would be my only comment.
All right, Herbert. By the way, if people want to get in touch with you or find out a little more about you and what you might be able to do for them, what should they do to find that information?
Yeah, simply go to Aspire Growth Advisors with an S.com. You're going to see a complimentary business readiness assessment. If you're not sure how ready you are to scale, take it. It will give you a baseline score. I also have a high impact CEO assessment to see how ready you are to lead a scaling up company. You're welcome to schedule a complimentary coaching call where I would review any of your results with you and give you any advice or recommendations from there.
I've taken both of those. So, and I think they're very eye-opening, quite honestly. So, and I think, Herb, that maybe we'll have you back on some other time to talk about just scaling up in general, and we can go through some of the questions on that checklist. There's some things on my answers that I think we could talk about, and so much more. So, Herb Cogliano, thanks for joining us.
It has been a pleasure, and looking forward to getting back with you down the road.
And our thanks to Herb Cogliano for joining us to talk about all issues relating to exit planning strategies and also scaling strategies for your business. This episode of Accounting in the Wild was brought to you by MyCPE1. To get CPE credits for watching this episode, head over to my-cpe.com and continue your professional learning journey. Join us again next time on Accounting in the Wild.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dynison.